Good morning, good afternoon, good evening, depending where you are on the planet. And welcome to the Bull versus Bear webinar on Monday, the 30th of January. Steve Miley on the call here for Trade Day. Welcome, everyone. Happy Monday. Are we ready? I've got to say, I've been doing this for 30 years. And this has got to be. I mean, outside of obviously we've had a lot of those 30 years, a lot of huge kind of geopolitical events that have impacted markets, and there have been some busy weeks with respect to those geopolitical events. The last 2-3 years. I don't need to tell you, we've got a war going on in Europe. We had a global pandemic, blah 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 blah. Trump, Brexit, all that kind of stuff, right? Markets have been kind of chaotic, on and off because of those bigger geopolitical events, but I don't think I can remember, well, not for some time, a week where we've kind of had all the non-geopolitical stuff, the stuff that you can't quantify, right? And by the way, we are coming up to the anniversary of the invasion as well, and there's a lot of talk about stuff around that. And obviously the offensive, they started back in February because that's, weather-wise, so we could be getting a spring offensive, but all of that aside, right? I can't remember, not very recently anyway, a week like we have this week with a cascading of basically data, macroeconomic events, and micro earnings events, all pocketed into literally it's actually, if you look on the US side, it's a 3-day window, all right? But, even taking in the European stuff, we've had out some today, and we'll get coming through tomorrow. It's a 5-day window, but I mean, we'll run through it now. I do want to run through it. It's going to take up most of the webinar. I'll try to dab into some of the charts at the end, but it's going to take up quite a bit of the webinar. I also want to look at the Fed tool as well today. So I think it's a good way to set up the shape of the week, right? To look at the whole week. So let me zoom in on this. So this is, you got this anyway. You get this, if you don't know, this is in the trading room where I post my technical analysis reports, on the main room of the trading room, on the members area for trade day. If you go there, you can download this and put it up usually every Saturday or Sunday. Usually comes up on a Sunday. So this trade day kind of recap and outlook for the week. Now the recap, I'll go through the recap fairly quickly. Last week was a bit more, that you would have thought that the focus would have been on the earnings, okay? And I said last week, I didn't think GDP, doesn't usually move market, durable goods. PCE was probably the more important data, but you know what? Most of the data, the earnings data, was negative. We had Microsoft and Intel, which were pretty negative, and those stocks plunged. So the big names are really Microsoft, Intel, and Tesla. And Microsoft, Intel were very negative, Tesla positive, right? So if we look at all of that in there, that was probably a net negative from the earnings side. And the macros, didn't really expect it to have much of impact, but I think it did. I think, the fact that we had that day of US GDP and durable goods data. Durable goods data was particularly strong. US GDP, highlighting, what the Fed speakers have been trying to, we're sort of almost saying, could we be on for a soft landing? That is no recession. Have the Fed managed to do their job amazingly, and also major global economic centers around the planet, Europe, I've stressed this, really thought Europe would hit recession. In the UK, even if it was a mild, even if it was like a mini, somewhere between a hard and soft landing, right? A mini recession. It doesn't look like we're going to get that. We could further out. A lot of talk now, Pacey, about double dip recession. Will we get, if we don't get a recession the first time around, are we going to slight recover and then maybe going into late 23, maybe into 24, you get more of a negative impact. But anyway, as we get maybe another bout of inflation come through, who knows, right? That's going a long way out. But what I can tell you on the short term is that markets took the mix of this. So the micro, which was kind of mixed to kind of negative, but the strong macro as overall risk on. Stocks went higher. Bitcoin went higher. And if we go down, and I just scroll down to the charts in here, you basically had stocks, US was up, Europe was solid. Yields didn't really move. Yields on the dollar kind of went sideways, but within that sideways, still all the pressures are down. For both the yields and US yields and global yields, European yields as well, and for the dollar pointing lower, the dollar index and the dollar against most other major currencies. Gold even though we're in risk on and gold is a safe haven, so usually does better in risk off. The fact is gold is pushing higher. Now, there's a great article. I need to share this with you guys. You go to FX Explained. So I've got he's a friend and an esteemed colleague, okay, called Sean Downey. He's been in the markets even longer than I have. Blimey, that's saying something, right? 35 plus years, I think, and he's a technical analyst and he's very, very, very good. I've got this gold special. I'm going to put it in the chat. If you go to FX Explained, which is like a site that I co-own, education site in here, gold special. Don't miss this. Gold highlights heightened fear, historic bull threat. There's a great piece on the futures markets in here on gold from Sean, looking at futures as a fear rating, gold futures, and the spread, looking at 30-year extremes on some of these spreads. Correlation from 97 is historic bull threat for gold. And remember, even if you don't believe it's because of fear, because of, he's pointing to maybe Ukraine. But even if you don't believe that, right, the chart's telling us we could go high. It's been a really strong rally. It looks bullish to me. It looks continue to be bullish. And we're coming up to some major peaks in here on gold. So not what we're coming up to right now, but, they are in the crosshairs up here. So we could see this gold rally. And the dollar looks weak. The dollar goes down, gold goes up generally, right? Crude has kind of been sideways. We did get a rebound and a bit of a failure last week. And then overall looking for me more bearish, and copper remains bullish in here with the dollar weak. So just that was skipping ahead to the charts in here. But net, we sort of stayed in a risk-on theme. You look at Bitcoin as well. Bitcoin's leapt higher as well, as did all the cryptos over the weekend. So crypto's looking bullish, and that's clearly trading more in correlation as a risk asset. So, so all of that was last week. And then, I kind of run through in here what the markets have done as we look through the charts. But let's take a look ahead to this week. I mean, it's massive, right? It's absolutely massive. Central banks, first of all. Now, clearly for you guys, we've got the Fed, right? But just to remind you, we have the Bank of England the day after. So the Fed on Wednesday, okay? But on Thursday, we get the Bank of England and the ECB, the European Central Bank, both on Thursday, both expected to hike rates again, okay? With the Fed now slowing to 25 expectation. We'll come and look at the Fed tool shortly. For Europe and for UK, we're expecting 250s again, 50 and 50 again. So if I scroll down in here, you see on Thursday, should show it in here. Where are we? Bank of England, Thursday, Bank of England, looking for a move from 350 to 4. Okay. Expectation of the vote is 7-2, and then looking for a move from 2 to 2.5 from the ECB. Okay, or depending which metric you look at, 2 to 2.5 or 2.5 to 3, depending on the metric. They've got the various different interest rates, but looking at for a 50 basis points anyway from Europe. So we have those coming up, right? So that's big enough anyway. Yeah, but that happens quite a lot. We get the Fed and the ECB and the Bank of England all consecutively over it's less than a 24-hour period, about a just over 12-hour period, I think it is. Fed, for my time, Fed comes out at 7, and Bank of England comes out at noon, and this comes out at 12:31 or something. So you've got that all in a space of less than 24 hours. But we've also now, putting aside what we've got coming up later in the US, but today we've already had German GDP and EU consumer confidence. They're already out. Okay, we'll look at those shortly. Tomorrow we get German retail sales, German CPI, and then we get US consumer confidence. We do get some US data of note tomorrow. And then Wednesday it starts to really hot up. So Wednesday we get the S&P Global manufacturing data, okay, and then we get the US ISM manufacturing data, and then on Friday we get the US ISM and the S&P Global service sector, and for the S&P Global, the composite data, okay, on Friday. And then also on Friday, you get the US employment report, right? So that's massive. And that's all loaded Wednesday through Friday, yeah? And Friday, double trouble, PMI composite, and service sector from ISM and S&P Global, and the employment report from the US, right? Now, if that wasn't enough, right, 3 of the world's, say 4 biggest central banks, the Bank of Japan aside, and Bank of Japan really is not doing too much, as we've seen recently. So of the 4 big central banks, 3 of them, and you put Japan to one side, 3 of the 4 are in play within 24 hours. You've also got the employment report and the PMI data. The PMI data tends to move move markets. Okay, we've got that, and then we've got all this other data, right? This other data in even Monday through Tuesday: German GDP, German retail sales, German CPI. Germany, the powerhouse of Europe. German data tends to move the European markets more than the EU data, even though the EU is for the whole, because the EU is kind of more diluted because it's the whole of Europe, right? The German data is seen as, right, if Germany's doing well, then we know the EU is doing well. The EU data, is taking in a massive area, so it's a bit diluted. So sometimes it's not, the market doesn't move markets as much. So we've got all of that coming up, right? And then if that wasn't enough, right, we're in earnings season, as you guys all know. And at the beginning of the week, we've got, and I'll run through these, on the calendar shortly, we've got ExxonMobil, Pfizer, Caterpillar. Now, don't forget Caterpillar. Caterpillar is often seen as the bellwether for the US construction industry. Okay, so it's obviously a very important sector. And to an extent, even for the whole economy. If construction's doing well, the economy is doing well. And if Caterpillar's doing well, construction's doing well, which means the economy is doing well. So this is often seen, can be a big driver for the whole market. Okay, so if Caterpillar has big miss or big beat, then often it can move the indices, not because it's a big stock particularly, but because it's that bellwether. And then we really get into it. Meta, Facebook, Instagram, WhatsApp, old Facebook we have. And then all on the same day, Apple, Alphabet / Google, and Amazon. Okay, so let's just take a look at all of those coming through. Nothing much today. Okay, if you look at the calendar in here for today, but as we go through ExxonMobil, Pfizer, Caterpillar, all on Tuesday. If we go through Wednesday, nothing too much. Meta. We get Meta on Wednesday, and then Thursday's the big trouble day. Not trouble day, but I mean we've got a lot. Alphabet, Apple, and Amazon all after the bell. Okay, so Wednesday through Friday is just absolutely massive for the markets, and is a fairly quiet to the end of the week on Friday. I just can't stress it enough, guys. And the fact that we've got hardly anything out today probably means it's going to be a relatively, in my opinion, quiet day. And it's no surprise to me that we've kind of nudged lower today, given that we've had a strong move higher over the last, remember, 4 weeks straight up now for the Nasdaq. Okay, if I go take a look at the chart in here, bring it up on the Nasdaq, and I flip it to a week. Oh, you can't do weekly on this, but it's 4 weeks up for the Nasdaq. Okay, 4 weeks, boom, 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 boom for the Nasdaq. Okay, so no surprising for me. And then a big up on Thursday / Friday, got very close to the peaks. Remember, I had this as a target. I said we could see it all the way up towards here, definitely up to these peaks here. We've noted. Okay, these are old failure highs that we saw from where were these? So this peak in here goes in December, right? So this was early December, and then latter mid-November. We pointed out these peaks. That's exactly where we got up to. Just failed above the peak on Nasdaq. It doesn't really surprise me with pulled back. It feels like it's going to be a mean reversion. We might even go a bit lower. I've got still got an overall bullish view in here, but we have taken out a little bit of support. If I was swing trading this, I'd be looking at this as a great buy opportunity over the next 24, 36 hours to buy in here somewhere on both Nasdaq and S&P, and looking for us to get through all of this data, all of these central bank events, all of these micro earnings events, and for this trend to continue. I do think there's a real risk for that. I think we're in a bit of FOMO in here at the moment, and I think the market's still the real players in the market are still underweight in here. And it looks like if we take out this peak here, and on the S&P. So I'm not going to go into massive detail in here. And we take out this peak here, okay, it starts to look like a much, much stronger recovery in relation to the bigger picture view of the whole sell-off. You can't really see in it because of the back data, but the whole sell-off of last year. So it looks like a much better recovery. And then particularly here on the Nasdaq, it's like a massive double bottom, right? If it takes out that peak there, okay, it's a massive double bottom through the peak, and we got very close there. My view is the market's going to take advantage of that, okay, and we will break up through there. Probably not ahead of Wednesday at the earliest, ahead of the Fed, but post-Fed I can see us getting through here. The Fed obviously could see the market getting a little bit too ahead of itself, getting a little bit too dovish, and it might want to send a still hawkish signal. So we'll see. Okay, we can't second guess that. But for me, the underlying tone as a swing trader, now I know we're day trading here, but if I was approaching this for the week, I'd be looking to buy dips unless we get something significant that's going to change that view. And at the moment, we don't have that something significant. So the probabilities is for buying dips. Going into the day, yes, I can see it's weak, and we could probably end up staying weak. But I really want to point out, as I've said in the article in here, a massive week for markets, and really that kicking in from Wednesday onwards. But we do have important European. So we've had European data today. We'll get some important data tomorrow. I don't think it's going to be a big, busy day today, given the amount that we've got coming up. Let's just run through, though, 5 things in here to start your day. So what do we have? Well, chip route. Okay, so there's a glut of chips on the market, a semiconductor market getting hit by that. So that's seen as a negative taken into the day. First-time home buyers and small investors have the upper hand as opposed to sophisticated players that badly misjudge the property market. So battle in the property market there. Morgan Stanley traders piling into the rally in excess of forgetting the cardinal rule of missing. Don't fight the Fed. Okay, so they're pointing out, don't fight the Fed. You know, that we could see them coming in, being a little bit more hawkish. The narrative stays relatively hawkish, but they are edging away from that. And I do want to go and take a look at the Fed tool in here. NASDAQ leads dropping futures ahead of Fed rate decision. That's this morning. And then US futures drop as rate decision. So I think this is just mean reversion. This hasn't helped as well. I think, just a bit of unease about this whole Adani route. Okay. It's obviously not directly impacting US markets or even global markets. Obviously, it's very based on the Indian stock market, but nevertheless. But Bitcoin and the crypto, as I said, leapt higher again over the weekend. The last 3 weekends, crypto has leapt higher at the weekend. So that's kind of interesting. As soon as the actual official kind of futures market shut on Bitcoin, and it goes to the cash markets are let loose and they've jumped the last 3 weekends. So looking into the day, you see European bourses are slightly lower. The FTSE is actually holding in at flat, but we're between 0.5% and 1% down, depending where you look across the board on European exchanges. And as I say, NASDAQ leading the way down this morning. We're over 1% down on the NASDAQ as well, so giving up most of Friday's gains. As I say, as a swing trader, I think we've still got the underlying bullishness. For me, for today, it's a little bit more tricky. I will have a quick look at the charts in a sec. Do you want to run through the CME tool, though? So we're kind of nailed on for the meeting this week for 25, and then in here, pretty much nailed on going into March for another 25, right? And if anything, a chance of unchanged. There's nothing being priced in here for a 50. Okay, so we're not looking for a total of 75 through March, and then we kind of just sit there, right? In here, so in here 475, 500. There is an outside chance of another move higher in here at the May meeting, but pretty much the market's more sitting with staying in here and on hold through the summer. Yeah, but this peak in here, if we go and take a look at the rest, there's very slim chance that we're going more than 75 up from here. So this is 75 up from here. That's June. If we go to July, so 500, 525 is as high as it gets. So we're either going up 50 or going up 75. That's what the curve is telling us. Yeah. Now, just a note in here, 450, 470. This is then in the November meeting. So we're kind of even between staying where at the 50 basis point up, or maybe a cut, okay, for November. But now in December, we're looking for not much chance of another cut. So staying at 450, 475, less chance. So more likely now up 50, potentially 75, on hold through the summer, and then maybe only one cut into the end of the year is what's being priced in now. So kind of a stepping back. So the market has actually stepped back from where it was. It was pricing in 2 cuts, now less chance of 2 cuts. So it is actually stepping back for the more dovish tone that the market has been striking compared to the Fed. Okay, see the Fed telling us they're not going to be cutting at all. That's what they're saying. They're going to we're on hold kind of indefinitely, basically, but certainly showing that the economy is staying strong and inflation is pointing in the right direction. That's what the Fed has definitely shifted that tone. It's going to be super interesting Wednesday through Friday, super interesting on Wednesday after the Fed to see how this changes. Okay, so keep where we are in these in mind. Right, just a quick dip into the chart. So yeah, it has been a significant step back in here. Let's start with the NASDAQ. We just start with, but you look in here. So we're in like a downtrend, lower lows and lower highs. Okay, we did take out this little swing low in here from Friday. We're holding above the lows in here though. Okay, so whilst above this area here, 12.025 to like 12.015, yeah, I'm clinging to the bullishness. And if anything, you can see this kind of sell-off moderating. Okay, and if anything, you'd argue here's the risk, right? That we reverse above that trend line. Now you can stay short if you want to be short below this trend line. If you break below this kind of 12,000, certainly, go with the bearishness. Okay, no reason to not go with that bearishness. But if we get back above the trend line, your initial little trigger in here is just above where we are. You got a little trigger on the top side, 12.083. Certainly above this little impulse point in here, 12,119, it starts to look a little bit more positive. So, I think, you're an easy stopping it below this kind of 12,000 area. So any reversal of this trend line with a stop below 12,000 looks like a good trade to me. Similarly on the S&P, okay, we sort of went up into that area I spoke about. Remember the retracements? We looked at the 76.4 and the 78.6. We went right up into there and then stepped back, and then obviously notably lower in here today. But again, if I zoom in onto the 15-minute, yeah, we got the lower lows and lower highs. Yeah, we took out these supports in here, but it's holding above this one in here. So the key there is 40.27 1/4, holding above there, and not already trying to swing back higher. Now, the one off the top, do you take the one off the top? Because if you do, we're flirting with it now. I would suggest maybe a better one in here is got this initial impulse down, maybe this one across here. So you might want to be a bit cautious and go through here. So if you're really bullish, you're buying it, a break above like 40, 50, 40, 51, 52, you're going long. If you want to be a bit more cautious, you're probably waiting through 59, 60. Okay, on the top side. The stop's probably then down below that low there, as I say, 40.27 1/4, maybe 40.26.25 kind of area for your stop. And then we could be back up to the highs. This feels like it's been a correction in Asian European time. I could easily see buyers coming in again today. Could be a mean reversion day. And if it is mean reversion day, you've already had the setback in here. Maybe it just pops back in and sits in here somewhere. Maybe it pops back up towards like, I don't know, 40.80, 40.90 kind of area. And just sits there going into Wednesday. So, we're in the setback. Don't get too bearish on this setback is what I'm really trying to say. Let me go take a quick look at the commodities. So first of all, on gold, sideways, 3 down, as we were talking about, most we've had in the whole rally in here since the beginning of the year. It's all the way back here till November. Okay, this whole rally, the biggest we've had is 3 days down. This is the 3rd day. Okay, so looking for it to stabilize, and we've kind of held this whole support area between 1918, 1910. It's been very solid holding there. Looking for it to swing higher, go into the 15-minute in here now. Where's the swing? Well, look, I think, it really has got to clear back above here. 1933, 1935. You got all these peaks in here. So you need to get back above there. Down through the low in here looks more negative. So very rangy, but upside potential still for me on gold. Let's take a look at oil. Kind of choppy sideways, slightly more negative in here. Okay, looking at a potential 1, 2, 3 triple top pattern on oil. But really, it's a bit of a chop fest, right? I think it's tricky to trade. I wouldn't really want to be involved in that one. And we're going into OPEC. So maybe, I didn't mention OPEC as well. I forgot to put it on here. I forgot to put OPEC on here. If we go onto the daily calendar, OPEC is Wednesday. Where is it? So we've got OPEC Plus on Wednesday. It is on here somewhere. I missed it off the calendar. There it is. OPEC Plus. So we've got OPEC Plus. So watching out for that as well. Okay. So no strong view there on oil. A very, very quick nod to the treasury market. Same, turning a little bit more negative in here. I've been turning slowly more negative on here. And I think real risk, we're sitting right on that little low there. We've taken out this, we kind of held above this impulse level around 114, 15. Okay. What's the low actually? 114.16. We're kind of flirted with that. We're kind of down through that now. And then you've got the actual little swing low there is 09.5. The current low is, actually, we just nicked through at 09. So yeah, this looks more like a topping pattern. I think there is downside risk for treasuries. Okay. Well, that's the 10-year note. Sorry. Anyway. All right, then. I'm going to wrap it up there. Any questions from anyone? Give you a second to type. Never get any questions. You guys need to be a bit more bold, I think. Feel free, guys. Come back tomorrow. Ask me a question. I'll be back with you tomorrow with another bull versus bear webinar. Until then, take care, stay safe, and get ready for a massive week, I think. All right.